According to Bloomberg, mainstream U.S. financial media, the London silver market is suffering near total illiquidity. Traders short on physical silver are scrambling to secure metal, often paying extremely high borrowing costs to maintain their positions. There is no liquidity available currently. What we're seeing in silver is entirely unprecedented, said Anant Jatia, Chief Investment Officer at Greenland Investment Management. Now, multiple major investment management firms, TD Securities, Greenland Investment Management, and JP Morgan, who are involved in this trade, are reporting the same thing. So we pretty much can say that there is a worldwide global silver squeeze going on, that the last bastion of supplies may actually be in the United States, and we'll get to that in a moment.
RobertKientz's analysis of silver begins with a simple but powerful premise that silver is both money and industry's hidden engine. Unlike most commodities, silver carries a dual identity. It is a monetary metal that has preserved wealth for centuries, and at the same time, it is a critical industrial material essential for modern technologies. This unique role gives silver a depth of demand unmatched by almost any other element. Kientz argues that this dual purpose is exactly what makes silver the most undervalued asset in global markets today. In his view, investors and policymakers have been lulled into complacency by low nominal prices, failing to recognize that structural imbalances in both the financial and industrial worlds are setting the stage for an explosive revaluation. He often highlights that silver's supply dynamics are fundamentally constrained. Global mining output has plateaued, and over 70% of silver production comes as a byproduct from mining other metals like copper, zinc, and lead. This means silver's production cannot easily respond to rising demand. Miners can't just turn on new silver supply when prices climb. Meanwhile, industrial use continues to expand rapidly due to its irreplaceable role in electronics, solar panels, medical applications, and electric vehicles. Kientz believes that this mismatch between limited supply and surging demand is a ticking time bomb that the broader market has yet to price in. When it does, he predicts, silver could experience a structural repricing similar to what oil or uranium markets have seen during past shortages. Another pillar of his outlook is the growing stress in the physical silver market. Kientz frequently points to signs such as elevated premiums on bullion, delivery delays, and shrinking inventories in major exchanges as evidence that the system is quietly tightening. He argues that paper silver, the vast network of futures, ETFs, and derivatives, has created an illusion of abundance that will shatter once investors demand real, deliverable metal. In his analysis, the gap between paper and physical markets will eventually trigger a short squeeze, forcing prices to adjust violently upward as supply dries up. This, he says, could be the spark that pushes silver from its current undervaluation into a phase of explosive price discovery. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
As we get into the middle of the month, we've had some very interesting things go on in the silver market, and that's what I'm going to be talking about today. I got lots of charts and things for you guys, so we're just going to jump right into it. There have been reports of a silver squeeze 2.0 in the silver market, and we're going to go through what's going on and the reports in the press. Now, before we do that, I wanted to note that last time we had that silver squeeze back in the 2020-2021 timeframe, prices got tamped at 30 here in the US on the markets. A lot of the flow was going into ETFs. And I said, honestly, that's paper silver, and we wouldn't have a real squeeze until people actually bought the silver and took it off of the market. Because what happens when you buy silver in the ETFs, most of that is stored in the UK or the London market underneath what the LBMA manages, or underneath what that London market manages. And it basically just stays in the warehouse and gets traded back and forth. But to actually have a silver squeeze where there's not enough available physical silver, you can't do that in a contract or a paper trade. You basically do that out of the physical markets. And that's exactly what happened. And I predicted this would be silver squeeze 2.0 several years ago. I said, when silver squeeze come back, it's going to be because, you're having a physical squeeze. Now, I have documented on previous shows recently that there was over 200 billion investment into the SLV silver ETF in the last, I think, 6 months or so. And then in August, it blew out and there was a whole bunch. Just a bunch of silver investment. So it always starts that way. It always starts with the generalist investors or even silver investors that have access to funds in some sort of here in the US, like a trading account or a retirement account. Most likely it's like a Schwab account or E-Trade or something. And they want to take those funds and move them in to get silver price exposure. They're not necessarily trying to take delivery. And in fact, through a lot of these ETFs, you can't take delivery. Well, what we've got going on is now we're having a squeeze in the London market. And we've got a quote here from Robert Gottlieb in a Jerusalem Post article that says, "No free floating silver left." I'm going to walk down this article and another couple of articles, and then I'm going to go over the data so that you can see what's actually going on. It says here, quote, "For years, whispers of a coming silver squeeze have echoed through precious metal circles. Now it appears the moment has arrived and the consequences are reverberating from London to Tokyo." As Robert Gottlieb, an executive at JP Morgan Bullion Bank, bluntly put it, there is basically no free-floating silver left. That declaration, coming from one of the most powerful insiders, has electrified the metals market. Lease rates explode, short sellers panic. Silver lease rates, the interest paid to borrow physical silver for delivery, have rocketed by 20 to 30%, far outpacing those of platinum. This is a rare signal of scarcity in an otherwise abundant market. A recent J-Post analysis of the current silver squeeze explores how London's shortage is just a preview of what may come when the paper silver system begins to unravel. As a side note, I've had it on my channel, Twitter for sure, and on YouTube, how the TD Securities market analyst came onto mainstream media and said that Silver Squeeze 2.0 was starting and it would be a physical one. So this has already reached mainstream news and it's starting to reach press around the world. Going back to the article, quote, "Simultaneously, both gold and silver recently smashed through critical psychological levels, piercing the $4,000 and $50 thresholds, signaling powerful momentum, as detailed in J-Post's report on gold and silver key levels." I'm going to get back to how these technical and psychological levels work in the market. There's been criticism of me and other Western market analysts on various channels lately of continuing to follow technical trade and saying that has nothing to do with the market. And I'm going to prove to you that it does, that you have to follow technical and fundamentals. I do believe fundamentals will eventually overwhelm technicals. I've said that in my entire career and writing about gold and silver dating back now 16 years when I started writing for Seeking Alpha and got syndicated across numerous mainstream publications, including Yahoo Finance, NASDAQ, MarketWatch, and others when I was writing. And it does matter, but we'll get back into that in a moment. Going back to this article, borrowing silver now costs 12% if you can find it. On the paper side, and again, this article is acknowledging the paper side of the trade, the iShares Silver Trust, SLV, which I referenced at the beginning of the video, is now seeing borrow fees near 12% with no shares left to short. For those betting on downward price movement, the pain is intensifying. They're forced to pay steep borrowing fees while incurring losses as prices climb. These shorts are literally being squeezed in the paper market, which is going to lead to an explosion because the physical market is also being squeezed. There's more demand for supply. Continuing on, this squeeze operates from both sides. Rising prices erode short positions, while lack of availability and soaring borrow costs tighten the noose. A related J-Post feature on ETF pressures and borrow costs shows how these dynamics are reshaping the market. Gottlieb's statement about no free-floating silver is no idle rhetoric. It reflects the reality that virtually all deliverable silver, that is physical, the metal could be transferred or leased, is tied up in ETFs, industrial contracts, and other long-term commitments. As I've said on my channel repeatedly over the last few years, this was happening and is going to happen. Little remains unencumbered, meaning free. One J-Post investigation into physical silver scarcity highlights how cross-border flows and deliveries are already being affected. And we're going to go to the next article from J-Post. This one is USA sends silver bars to London as historic squeeze hits. The US has shipped silver bars to London as an historic market squeeze pushes prices above $50 an ounce. Physical shortages and soaring premiums signal unprecedented global silver stress. This is reported on October 12th, just a couple of days ago. The global silver market, according to the article, is facing an unprecedented crisis as a severe physical shortage in London forces U.S. silver bars to be flown across the Atlantic to stabilize supply. Benchmark silver prices have surged above $50 an ounce, marking only the second time in history that a precious metal has reached such levels, recalling the infamous 1980 Hunt Brothers squeeze. Liquidity crisis hits London, which, by the way, it hit London before, I guess about 6 or 8 months ago, maybe a year ago. I don't remember the exact timing, when there were reports that London didn't have enough physical silver. And I had been reporting the chart from the LBMA's website where the silver held had been flowing down and down and down. And on that chart, we didn't know how much was already committed to things like ETFs and other private contracts because not all of that's reported. But you could pull that chart about London inventories and ETFs and see that the free floating was shrinking by looking at the two charts. I did that probably 30 or 40 times within the last 2 to 3 years. Well, now it's hit. Now we're seeing what's happened as that's been drawn and more is flowed into ETFs. That gap between free floating silver and claimed silver in the London market is now reaching a crisis level. According to Bloomberg, mainstream US financial media, the London silver market is suffering near total illiquidity. Traders short on physical silver are scrambling to secure metal, often paying extremely high borrowing costs to maintain their positions.
From a macroeconomic standpoint, Kientz links silver's long-term strength to the weakening credibility of fiat currencies and the global debt cycle. He believes that as inflation persists and central banks resort to more money creation to sustain over-leveraged economies, confidence in paper money will continue to erode. Gold will naturally benefit from this shift, but silver, being both a monetary and industrial metal, could outperform in percentage terms. He calls silver the poor man's gold, a gateway for average investors seeking protection from currency debasement. In times of crisis, silver becomes more than an investment. It becomes a form of financial independence, a tangible hedge against systemic instability. Kientz also acknowledges silver's volatility, describing it as both a blessing and a test. Because of its smaller market size, silver tends to exaggerate movements in both directions. This means that while corrections can be sharp, long-term holders are rewarded for patience. He cautions that institutional manipulation, derivative suppression, and short-term speculative swings may continue to distort prices temporarily. He frames these fluctuations not as risks to avoid, but as opportunities for accumulation before the world recognizes silver's true scarcity and importance.
I think this is now, we're in the era of monetary demand in silver, and that's what's pulling up the price of silver. Persistent investment demand amid Western debt concerns and fears of currency devaluation, just as the article says. Structural decline in London inventories. Available silver, remember ETF trade removes available silver off of the markets. Available silver has fallen from over 850 million ounces in 2019 to just 200 million ounces today, a 75% reduction in 6 years. A spike in Indian purchases during Golden Week, shifting demand from Hong Kong to London. This is normal as India has demanded a lot of silver, and they did that when India put some import restrictions on gold. People flipped to silver, but they use gold and silver in their love trade. So does China. This is the time of year it happens. That's one of the reasons you get cyclical uptick in prices in gold and silver, is because of that intense physical demand in those Indian and Asian markets. But we're also in a squeeze, so it's accelerating, and that's why silver has popped past its previous all-time non-inflation adjusted high of $50 an ounce. We haven't gotten to the inflation adjusted high, so I expect it to continue to march on as well. Potential US tariffs on silver imports adding uncertainty to global supply is another reason. In the quote, the remaining free float of metal has dropped to just 200 million ounces, down 75% from 2019, Bloomberg notes. Even exchange-traded funds are suspending new inflows. Kotak Mahindra Asset Management cited a shortage of physical silver in the domestic market, with premiums sharply above international bookmarks. You're starting to see areas have higher premiums due to what? Local supply and demand characteristics. What have I been saying for years is going to happen to the precious metals markets? No longer will London and the COMEX and the US control prices, because when the physical squeezes come and when that demand surges, the markets are going to break apart into regional markets on premium pricing and on physical deliveries. We're seeing the US fly bars to London because different regions have different characteristics. No longer are we going to have spot prices and premiums, the actual price you buy, controlled by two major hubs in the world. That is changing as of now. And those price mechanisms are going to shift east to the BRICS nations, to China, India, and Dubai. The London Bullion Market Association, according to the article, has acknowledged tightness in the silver market and confirmed that it is closely monitoring the situation. Price dislocations reach historic levels. The squeeze has caused extreme dislocations in pricing and trading. London spot premiums are now up to $3 per ounce above New York futures. So that's why you're going to see the scalpers come in and play that trade, because if London's higher than the US, they're going to play that trade on the paper side, and it's going to exacerbate some of the issues with pricing that eventually is going to cause that pricing model that was congruent or together between London and New York start to split and to fade. And then again, these other regional markets are going to start taking precedence on the actual physical trade around the world. And so spot prices will no longer be determined just by the London and the COMEX, the spot and futures prices, and how close they are together. I should say that. Overnight borrowing costs exceed 100% annualized, likely surpassing levels seen during the 1980 Hunt Brothers squeeze. Bid-ask spreads have widened from a normal few cents to over 20 cents per ounce as banks withdraw from quoting. We've had several banks stop quoting, and that has been in the news. Banks don't want to quote each other, so the quotes get extremely wide, said Robert Gottlieb, former JP Morgan trader. Why? Because of regional differences in supply and demand and the derivative markets and how they're pricing. That's why. All right, there's more on that article. We're going to move on. There's an article in Bloomberg. I'm not going to unlock the paid edition, but this was an early report. But the next Bloomberg article on Yahoo Finance is even better. So I just want to show you silver traders rush bars to London as a historic squeeze rocks market. So yes, we're shipping them over there from the US to the UK, and I just want to confirm that with a mainstream source. Here's a really good article on Yahoo Finance breaking this down. But it's going to show that the squeeze has some signs of easing. So there is some temporary liquidity and physical being provided to the market. But as the U.S. drains their physical to London, what's going to happen is you're going to start to see silver squeeze come to the U.S. So this is temporary, the article I'm reading to you today, but I wanted to put out that there is a temporary little respite in some of these pressures, not completely, but this temporary respite or pause in some of these pressures or slight reduction or mitigation of some of these pressures is going to be exacerbated as the U.S. runs out of silver supply, because we might be the last bastion of physical silver supply. And that's not saying much because we ain't got a ton over here either. From Bloomberg, silver falls as London market squeeze shows some signs of easing. This is on October 14th. Spot silver prices retreated after hitting an all-time high earlier Tuesday as a historic squeeze in London began to show some signs of easing, although supply remains remarkably tight. Spot prices for silver fell 3.4% after hitting a record $53.55 an ounce in London earlier Tuesday. That's about $1 higher than the peak set in January 1980 on a now defunct contract overseen by the Chicago Board of Trade, Hunt Brothers, so on and so forth. Concerns about a lack of liquidity in London have sparked a worldwide hunt for silver, with benchmark prices soaring to near unprecedented levels over New York. That's promoting some traders to book cargo slots on transatlantic flights for silver bars, an expensive mode of transport typically reserved for gold, to profit off of higher prices in London. Again, another confirming source saying the same thing, that we're having some shortages in physical in London because of ETF demand, which I've been documenting over the last several months, how it's exploded and how this is capital rotation of other markets flowing into silver through these derivative contracts that are ETFs, and they're derivative because you can't get the physical silver unless you're an authorized participant in most cases. And like on the SOV and GLD, I think it's like 50,000 shares or something like that. So the average public does not have redemption rights. And on most ETPs and ETFs, you don't have redemption rights. Very few do you. And even if you go to the Sprott one, you have to have a lot in there, the PSLV to redeem, or else they're going to cash you out in cash. So when you go into these types of investments, they are derivatives because it's really hard to get the actual physical silver. Reading on, these silver bars will start arriving in coming weeks, multiple traders said, and the arbitrage trading has already substantially eroded the premium. The gap fell to about $1 an ounce on Tuesday, down from a spread as much as $3. So if you look at this chart, you can see the spread versus COMEX had widened on the chart dating back to about right here, and then it kind of plateaued here, and then it's rising up as the expectations in mid-October are that silver bars are coming. And this is just the arbitrage. It doesn't mean the physical silver trade is completely relieved, because if demand keeps rising, more bars have to be sourced. And once the U.S. market runs out of them, they're going to have to go wherever else in the market anybody wants to sell at higher prices. And if that's not enough, then you have to go to the mines. And the problem with the mines is the primary silver mines have not been expanding.
In the years ahead, silver is poised to undergo one of the most dramatic revaluations in modern financial history. As the global economy continues to rely on expanding debt and monetary stimulus to sustain growth, the quiet erosion of purchasing power will accelerate. Inflation may no longer appear as a temporary problem, but as a built-in feature of the system, a symptom of governments unable to live within fiscal limits. In such an environment, the world's appetite for real, tangible assets will intensify. Silver, long dismissed as an industrial byproduct, will re-emerge as a monetary refuge. By the late 20s, the cracks will become impossible to ignore. global mine output will struggle to keep pace with industrial consumption, especially as demand surges from solar technology, electric vehicles, and medical electronics. Stockpiles will shrink to multi-decade lows, and refiners will begin warning of physical shortages. Investors who once trusted paper-silver markets will start demanding delivery, exposing how little real metal underpins vast derivatives contracts. This shift from paper to physical will act like a match in a powder keg. Premiums will soar, supply will tighten, and prices could vault beyond previous highs in a matter of months. If you found this analysis valuable, don't forget to hit the like button, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps bring these critical discussions to more people who need to hear them.